Hi, everybody. Thanks for coming. My name is Sam Gaer. I'm the Chief Investment Officer at Monarq Asset Management. Monarq runs three core strategies, market-neutral dollar, market-neutral Bitcoin, and directional strategy, which I am fortunately or unfortunately in charge of in a market that has no direction. Before Monarq, I was at Block Tower. And prior to that, I had my own hedge fund called Katana Financial, which is how I got into crypto. We were one of the largest VIX traders on the platform, about 10% of daily VIX volume. Just through my knowledge of the exchange space, I got really interested in crypto, and we became one of the first market makers on the CME products and the CME platform. Prior to that, I held two pretty notable positions in the industry. I was the Chief Information Officer at FINRA for a couple of years, which was fun. And I was also the Chief Information Officer and eventually the EVP COO of NYMEX, New York Mercantile Exchange, largest energy exchange in the world, which did a $9 billion merger with CME. Started trading in the pits, so if you see my hands waving around, that's probably why.
Great. Good morning. I'm Duncan, President at 21 Shares. We are now Europe's largest crypto asset manager. We have about $7 billion globally, US, Europe, Australia, Brazil. And we began to be the bridge between crypto, DeFi, and TradFi. Started with ETPs and ETFs, now expanded to structured products, active strategies, and venture and other things to come. So very happy to be here, and I look forward to the discussion.
Yeah, and I'm David Kinitsky, Chief Corporate Development Officer at Everstake. Everstake's one of the largest non-custodial staking providers in the industry. Also provides different data and infrastructure solutions and increasingly on-chain yield strategies, which is kind of the rabbit hole that I've fallen down and why I'm excited about these conversations. I've been in crypto way too long, for like 14 years maybe now. I helped build Grayscale and ran it for the first couple of years of its existence before becoming Fidelity's first crypto hire. And then more recently was at Circle and Kraken before joining Everstake last year, in part because I was pretty excited about the on-chain yield kind of cycle to come.
Okay, so this is a little new for me. I'm usually sitting on the panel, not moderating, which is why I've got some cards. So let's just kick it off. So DeFi staking and yields is what we're going to talk about today. They no longer compete in. From several years ago, we had a zero interest rate environment, and from a yield perspective, they were very attractive when you have 8, 10, 12% yields. Institutions can now get meaningful yield in TradFi products, so crypto yield has to clear a higher hurdle on several levels. Anybody want to expand?
Yeah, sure. So I think that's correct. If you're just looking for exposure to yield and risk-free or relatively risk-free yield, yeah, like crypto will have a tough time going 0 to 60 in that competition. I think it's incremental though, right? So you see it starting with, well, look, if I'm going to hold Ethereum, Solana directionally and especially long term, why wouldn't you stake it and get a little yield? So you get this kind of like baby steps, right? So that's kind of like where we are now. And then obviously you're starting to see some different vaults and on-chain and DeFi strategies for yield, but there's still a lot of like headline and actual real risk, and people are trying to figure out how to price that. So if you're a large-scale institution, you're probably not going to come in and get into like a pretty like a loop staking strategy or a DeFi vault if you're just looking for yield risk return profile and you're comparing it to treasuries or things that you could get in the traditional finance world. You're probably not going to make that decision. Mm-hmm. But if you're already exposed to crypto and you're looking to like eke out a few more percentage points, then it could make sense. I think that does change over time, and I do think that like the structural element of I see a lot of similarities now in DeFi and on-chain yield that I saw early in crypto, where it was like all this headline risk and all this actual real risk that people had to digest and price. And that pricing exercise is going to be key over the next few years.
Yeah, I mean, interesting. We were talking just about the general, about how crypto is so out there and so social and so instant that as an industry, sometimes we don't do ourselves a lot of favors with all the FUD and all of the stuff on Twitter. So Duncan, would you expand on that?
Well, I mean, I completely agree. I mean, the point is that for many investors, they want that crypto exposure anyway, so it's kind of crypto plus. I kind of think about it more in terms of utility, like the utility that they're looking for, and that will change depending on the type of investor. I mean, people were happy with no return on stablecoins, right?
Yeah.
So now the big institutions who can get yield in the traditional kind of wrappers and traditional ways, yeah, I get it, but there are many types of investors in this market.
Yeah, I mean, look, the industry has changed dramatically. So when I first started making markets in 2018, but really got full crypto in like late 2020, and a conference like this, A, probably wouldn't exist because there were no institutions, and B, everybody here would be in t-shirts and jeans. So.
Yeah. You can really tell what time in the cycle it is by what industry I say I work at cocktail parties. Like right now it's fintech.
Yeah, well, kind of is.
Yeah.
I had a discussion with our IC, investment committee, the other day. We were talking about hurdle rates, right? So what is the new hurdle rate, given we're not in a zero interest rate environment anymore? What is the new hurdle rate for an institutional investment committee in terms of crypto to justify the risk?
Well, I mean, I would say awkwardly it depends. It depends on the risk that you're taking. I think that like depending on how you can go very plain vanilla, and honestly, you're probably not getting anything much more than on cash. And you can take a huge amount of risk. And I actually think once you moved out that risk curve, the level of risk that you're taking, it's not as clear to most people. It kind of gets very blurry. Probably not enough operational due diligence and oversight being done today, I would say, compared to, let's say, the traditional world.
Sure.
Yeah, like I said, we're still going through this exercise of understanding the risk and then pricing the risk. So that question, we don't know, is the answer, the real answer. If like you had to like throw a gun to my head and say, hey, what would you have to accept? Like you don't care about crypto, you just care about like the yield of the return. Like it's got to be like low to mid double digits for sure. Like anything lower than that, if you don't really understand the risks at a deep level, it probably does not make sense for you at this point if it's just yield. But that said, I think that it's not just buyers who are looking for yield yet, but it's like people who have crypto and want to like eke out some more juice, or they actually have structural or utility needs for the crypto. Maybe they're like packaging it into a broader product or something like that, and that's I think where the next kind of like uplift will come. But the question is, probably it'll take us another year to 2 years to get like a consensus around what the risks are and how to price them, and duration, not just risk, but also like liquidity and duration.
Sure. I mean, like you choose the best tool for the job.
That's right.
Is what I like to say. From my standpoint, I am about delivering the best returns that I can to my investors. But you can also have a digital asset treasury company, for example, who's heavily invested in a token, and you know what? They're not going to invest in muni bonds.
Right.
Because they basically can't. So.
But I mean, you mentioned like that's there. So STRC, which is preferred
we're
equity.
gonna get to that.
Oh, we will. Okay, right. Well, I mean, if you believe in Bitcoin and Bitcoin will go up, that seems like a reasonable investment. But if you don't believe in Bitcoin, then it's probably not the right thing for you.
And then you'd have to look at it as a portfolio, right? Because if you believe in Bitcoin, you probably have exposure to Bitcoin already. So then what's the like overlap between that exposure to direct holding Bitcoin and then the exposure to the yield that only doesn't, well, I don't know if it'll blow up, but like it has like risks associated with the uptrend in Bitcoin.
Yeah.
Sure. So let's talk about why take the risk. As an institution, why would you take the risk? We're talking about Stretch, MicroStrategy preferred Cs. MicroStrategy preferred Cs, I got to give it to the guy, Michael Saylor, really great innovation here. Somehow, some way, he's created a new asset class, a preferred, which is generating 11.5% yield, monthly coupon. It's regulated, it's liquid, there's no lockup, and you're just in and out. So, and then when you add on, for most funds, either Reg T or portfolio margin, you're talking about a pretty significant yield. Now, it also becomes a crowded trade, and that's something that we're all very familiar with. So why would you take DeFi risk right now when I could say, hey, I'm just going to park money on a monthly basis into Stretch and get 11.5%?
Yeah, I mean, look, there's a spectrum of institutions. Institution's a pretty big word, right? There's all types of institutions. So yeah, like sovereign wealth funds and pension funds and teachers funds and stuff.
True.
They're not gonna deploy into a bunch of DeFi vaults and stuff at this point in time. And as you go down, so where are we kind of right now? Well, one, bigger institutions who offer, as we said, like a crypto exposure and want to get a couple points, they're there. But then I think there's a whole host of trading funds and trading strategies and investment funds who are a little bit more nimble, who are more operational in nature, and where we're seeing that interest is folks either one, who have a crypto treasury, as you mentioned before, and two, these funds who are more active in nature and are looking at it as a portfolio play. So it's not just like I have $100,000 that I need for like my wife and kids, and I like want to make sure I get like a steady return on it. It's like, no, I have this whole portfolio, and over here there could be a piece that like actually is very compatible and supplemental to my other crypto or non-crypto holdings, and how do you manage that as a portfolio? That's where we're seeing a ton of interest. But you're right, at this point in time, like the most white shoe of the institutions, it's probably not going to make sense outside of like a packaged ETF wrapper.
Yeah, I mean, I think like with DeFi, at least the source of returns will change over
Yeah.
time,
Oh, yeah.
and certain types of investors can assess that. Some won't be able to look at it. Whereas with Stretch, with STRC, it's also a belief in a person as well, not just Bitcoin. There's the trust in a person. I mean, I will say that we launched an ETP in Europe on STRC. We have never had more inbound inquiries for any product, so any crypto product, as we have with STRC.
Yeah, it's sometimes I do a lot of movie quotes, guys. So if anybody's familiar with The Godfather, that scene where Don Corleone says, "What have I done to deserve this generosity?" Right? If the trade is too simple, which it seems like it is, do we run the risk of it being crowded? Do we run some sort of blow up risk? And oh, by the way, there are other vehicles out there, even like on U.S. Treasuries, you can get 5%, right? Or close to 5%, right? So why don't you guys comment on, from a risk-adjusted and a portfolio composition basis, give me an argument for DeFi in addition to Stretch.
Well, not everybody can actually, if you run a crypto portfolio, you might not want to hold a traditional security. You might not have the custody set up, which is almost like the opposite problem to a lot of TradFi investors have. Liquidity, timing risk on the yield. Right now, at least STRC pays once a month. And you have the ex-div date and the payment date, which differ. So it's very different to DeFi. So I think you probably have a lot more flexibility in DeFi than you do with that single.
Yeah, that's right. I think it depends who you are and the purpose that you're getting into this for. And the point is made well that we have a very US-centric view here as well. There's a big world out there. Obviously, the biggest capital markets are here, but like especially outside of institutional, if your institution or going direct to consumer or institutions like B2B2C, like there's a bunch of consumers out there that can't access a lot of the products that we're talking about. Now, of course, that's not where a lot of the dollars is, but like in aggregate, that's a real like demographic. And in fact, that's where stablecoins like kind of started coming up and getting bigger outside of just crypto trading. Like it was offshore, kind of like shadow and offshore dollars. That's a use case, and that's an increasingly growing one. Crypto companies, treasuries, things like that. And then like market makers and other trading funds, and just like I said, institution's a big word, yield's a big word. Because where does the yield come from and what is the structure of it? I mean, it could be a SEX-DEX ARB. It could be like basis trading or funding rate trading as opposed to like staking or just credit and lending. So yield's a big word too. And then within each of those sleeves of the construction or the type of yield where it comes from, it could fit nicely in a portfolio, especially if you're a market maker and you're like, hey, funding rates or SEX-DEX ARB. So there's a bunch of different ways, and we'll start small and snowball, just like crypto does. You kind of find like the next stepping stone of use cases until there's a critical mass. We're just not there yet.
I think you hit the nail on the head, though, with there are a lot of people outside of the United States in this world who don't have access to U.S. products or don't actually, and I had this experience when I was in Europe for NYMEX, where people will actively avoid U.S. regulation.
Right.
So, and institutions as well. So let's talk a little bit, change pace a little bit. we're going to talk a little bit about the elephant in the room around DeFi right now. So we've had a pretty bad April when it comes to DeFi, right? We've got recent headlines and exploits, including Drift, Kelp DAO, and investment committees are asking whether DeFi is worth the operational and security risks, right? This is something that at Monarq, we talk about this. We have a risk committee every week. We do our market updates, and we are actively debating and discussing DeFi risks and yields and kind of like what is it that we're not seeing. So should institutions underwrite these risks, and if so, how?
Yeah, it's going to take a minute, depending on the type of institution. If I'm honest, like especially on the spectrum, like that it's a little bit more white shoe and bigger and more conservative. But I think it's like, look, it's a necessary growing pain. It's just like the same thing happens in crypto and all these markets where you, like, if these things weren't happening, one, there wouldn't be a resultant focus on the like understanding the structural risks and pricing them. And then two, it also is an opportunity for folks like the company like that I work for, or good builders in the space. It kind of the headline risk keeps a lot of people away. It kind of gives you a runway where good builders in the space who actually care about these things can build kind of while other people are scared. And so it's actually a bullish thing for folks like Everstake. But that said, it's going to take some time, if I'm honest. Realistically, I do think that there will be a period right now, kind of like bear market. Look, we're in a bear market, right? But by the time the next kind of like up cycle hits, whatever, if you subscribe to the 4-year cycles, we're going to have a lot of this figured out. But it's going to be like the early participants, like I said, who are already in there, have a much higher risk tolerance, or don't have the other products that are going to be the guinea pigs, so to speak, to figure this out. But there's a lot of...
Right. Duncan, how do you see that at 21 shares?
Well, I would say
You have a pretty unique vantage point, so I'm interested.
Well, I started my career as an allocator in hedge funds, and 2008 changed the way hedge funds operate. Like it matured the industry, it forced them to mature. There was much greater focus on operational resilience, compliance, governance. I think that FTX sort of kicked that off for the crypto industry. It's got a long way to go. I'm not sure today that institutions or just investors are even that strong at assessing custodians, let alone DeFi risk. Genuinely, I mean, definitely not staking. And so like, if we really want the big money to come in, unfortunately, I think groups like consultants are probably going to have to get more up to speed. There will be a reliance on third-party due diligence, and it's not there today.
There'll also be counterparties who come in and are willing to eat that risk, right? And who are basically going to say, like, we are the ones, we're going to figure this out on the backside, and we're just going to be your counterparty. Now, the creditworthiness of that counterparty or whatever, but if a big player with a big enough balance sheet or reputation comes in, they can kind of be the version of the DeFi mullet. And they can come in and eat that.
Yeah, interesting. And so, Duncan specifically, when does an ETF win? Right? When is the ETF, because now let's talk about ETFs, because it's something, again, another elephant in the room. When the ETF, when is the ETF wrapper the right answer? As it solves for access, custody, liquidity, compliance, and investment committee comfort, right? We're focusing a lot on the committee because it is an institutional conference, and I assume that we all now have structure in place, which, by the way, the industry didn't several years ago for investment committees and risk committees. So when is it the right answer, even if it sacrifices yield?
Always, right? No.
Well, it depends on your investment committee.
Look, it's the right answer if you cannot do all these things yourself. I think if you are a smaller allocator, there are some misconceptions around ETFs, like they cannot like stake a lot. They can, unless it's like, okay, on ETH, the unbonding and the bonding periods can vary a lot, so you have to pay attention to liquidity. But on things like Sol and other assets, you can actually stake quite a lot. So you can get a yield, there's not too much of a haircut. I think that, generally speaking, ETFs are the right answer for most investors in the traditional space. They're not the right answer if you want to trade at the weekend. Right? Like,
clearly, as we've seen over the past couple of months.
Yeah, that's what Hyperliquid's for, no?
Hyperliquid.
And VPNs,
Anyway, different panel, different topic. But so, Okay, so David, when does direct staking win? So, like, when does it justify the operational lift? Like, we've just been discussing all that it takes, and there's a lot more to it, obviously. But is it only for institutions large enough in this space to manage validator selection, custody, and governance?
Yeah, so I think you could insource it, and there are institutions that try to do that, but it's also about finding the right vendor or provider. And I think increasingly there are staking providers like Everstake and others that are more growing up, just like the investment committees and the structure that you're talking about coming to the fore. Us and our peers are growing up and getting, like all the SOX and compliance and like audits and things like this, and actually like can pass an institutional vendor diligence like process, right? Like that's pretty recent. So I do think that there's a lot of folks who are willing to take that and then package it into something that they're building, right? I mean, keep in mind, a lot of these ETF providers, they're also using vendors via their custodians or something. So it is a stack. Even when staking or ETF is the right answer for the end user, what's underneath there? A lot of times it's a custodian with a staking provider, right? Who is going direct. So I kind of think we're starting at the bottom now, and it'll kind of like go up. Obviously, I'm talking my book now. Right. It'll like kind of come up and eat there. So I think that'll happen over the next couple of years as well.
Okay, and we're getting a little short on time. So last question. So we've just discussed a whole bunch of stuff around institutional DeFi, et cetera, specifically ETFs and direct staking. So, and we've also discussed risk allocation. So when does the blend win, right? When is a practical institutional model blend of ETF for access and liquidity? When does that win? Is it a blend of ETF access and liquidity and direct staking for core strategic exposure? Or does this change over time depending on what exposure you want?
I've got a thought. I mean, I guess like it depends where you are. I think it's like a spectrum of who you are and what you want to use it. Some will use like just ETFs or instruments of some kind. Some will go direct. Now, who would be the hybrid type player? I think it's like someone who offers end user products and kind of like has their own active trading and or investment operations that really has some teeth to it. Because there's a ton, as I said, of ways to get yield out of this DeFi system. And the world is still figuring out how to connect this on-chain or DeFi yield to institutional capital. And so there's going to be a bunch of hybrid stuff while they're figuring out which way is better for them. So TBD.
I mean, like, I think about it. For us, we have Robinhood, Revolut. They offer our products, but they also have direct offerings. We have large like prop desks at banks that are doing both direct and into our products as well. Why would they choose our products? Well, because they can borrow. It's more attractive rates for borrowing than direct crypto, but they get the nimbleness of direct. So it is a mix, but our goal is to broaden out what we offer to investors. So we will be bringing DeFi into our products more and more as the demand moves there.
Okay. Final bonus question. Biggest, most significant prediction in the next year in DeFi? Something that's going to move the market. Something that's going to change how people think about DeFi.
I think you will see big asset managers start to manage actively in DeFi. I think DeFi asset management is a real thing that's happening, a shift that's happening now.
Yeah, no, I mean, I think that there's going to be, why don't I say this something provocative? There'll be no more hacks.
Wow.
I'll put that one on Polymarket.
I'll let you know what the odds are.
That's got to go on Polymarket.
I didn't say what the odds are.
That's got to go on Polymarket. Yep. Okay, well, thank you both for being here. Thank you, everybody. Are there any questions? Can we open up for questions? Am I allowed? Can we open?
Yeah, we have a couple of minutes if you'd like to.
Any questions?
You got to always have someone planted in the audience for that.
I know. Like I said, I'm new to the moderating thing.
When can we have the Everstake T-shirt that says there will be no more hacks?
Yeah. That's going to be the headline quote. Right?
Yeah, next year there were no more hacks.
I'm going to give pretty bad odds on it.
I think that's your drop the mic moment.
Or drop something.
Hi, question back here. Hi,
Yes.
Jerome Gregory, T. Rowe Price. Just curious to hear kind of what your views are on active management. within the ETF space when you're looking at like a basket of tokens or something to that extent. Not necessarily like a passive type of index product, but more so like an active component.
Well,
Kind of a loaded question.
we
for me.
we filed for one in the US. So we hoping we'll have one in the market soon. I think this is so we launched the first open-ended spot crypto ETP in the world, right? It was actually a basket product in 2018, and we thought basket products were going to be the thing. They haven't quite taken off yet, but I genuinely think that they are the right solution for like the kind of RIA space, advisors, and some institutional investors. Active is the next stage, and we've seen it in traditional finance. The move from passive to active within ETFs, things just move faster in crypto. So I think this is the way forward.
Yeah, for sure. There's going to be a bunch of different types of assets they're going to need to manage, but also like switching between them based on like duration and how much a particular network is offering or a particular vault is offering. And if you can manage that, there's going to be a huge uplift in what you can provide end user investors.
One more? One more.
DL, you mentioned ETH and ETH staking. What kind of strategies can you do to kind of shorten that on-bond period, especially when you start facing like tremendous redemptions? If you do, hopefully not, right? But
For an ETF?
correct.
Line of credit is one way of doing it. To be honest with you, it's pretty expensive, and we've not seen like the justification for it. And yeah, some form of line of credit, either across products or from other providers, would be the obvious way. Some people will do like a Lido in there if you can, but almost an ETF provider wants to have their products as broadly as accessible as possible, and not all exchanges will allow you to include Lido within it. So it's pretty restrictive. And people take a lot of risk on e-staking. Like insane, people are staking like 95% of their product on a product that's supposed to often offer daily redemptions. The unbonding queue got up to like 45 days at one point. And bonding, right? Like the staking queue is pretty, I don't know what it's like today, but it was pretty high as well.
Yeah.
So
It could be a month easy.
yeah.
Gotcha. All right. Thank you.
Great. Thank you, everybody.
Thank you.
Great being here.